the real message here is, from a career advice perspective, just be a banker, because you'll get huge pay increases, you'll be able to spend customers' money irresponsibly and then just get bailed out. I mean, it sounds
everybody
ideal.
hates you.
Sounds fantastic, doesn't it? Hello and welcome to Money Talk with me, Russell Quirk, the show that tackles consumer finance issues that affect you on a day-to-day basis. This week we're talking all things interest rates. Well, joining me this week is the business editor of the Spectator, Vander, and Vicky Pryce, an economist. Welcome, thank you for joining me. Right, let's get straight into this. Interest rate announcement, imminent. What do you think the Bank of England should be doing? So not what do you predict, but what do you think they should be doing based on where we are economically? Now, bearing in mind, we are in I think we'd all agree, an economically precarious position. And of course, in recent days, we've had news around Credit Suisse being swallowed up by UBS because it was in trouble, because it made a few, shall we say, rather questionable investments, and the same with Silicon Valley Bank. So I guess, what do you think should happen in terms of economic stability? And actually, do you think that the banking mini crisis, if it is that, will make a difference to the interest rate decision that the Bank of England will make imminently? Martin.
Thank you. Well, yes, I think it might make a difference to the imminent rate decision, but I challenge, anyway, three things you just said already. One is...
You're challenging me already. We're only a few seconds in. Okay,
well,
good. That's what this is about.
That's what this is about, right? But anyway,
go on.
So 4% is not really lofty in the long history.
So do you think that's normal?
That is a relatively normal range of interest rates to be in. We're not in a suddenly more precarious economic situation. We're in an economic situation which has been improving little by little from where we thought it might be by now.
The experts were telling us at the end of last year that we'd be in a deep, long recession.
Precisely
House
so.
prices would crash.
Yes, precisely so. 5 quarters of recession, and really quite a deep recession. Now we're still talking about not even being in a technical
We've had
recession.
one quarter.
So let's not attach precarious there to the economy. What's volatile or febrile, maybe precarious, is financial markets, which have been scared by two events, 5,000 or 6,000 miles apart. Silicon Valley Bank going down for its own set of reasons, and Credit Suisse going down for a completely different set of reasons.
So why should Mr. and Mrs. Smith of Basildon give a damn about Credit Suisse and Silicon Valley Bank?
Well, in detail they shouldn't, but it's affecting market sentiment, and it drove bank share prices down across the world, and now we're seeing share prices beginning to rally somewhat, certainly at the beginning of this week. So what I hope is that common sense prevails, and central banks, including the Bank of England, basically stick to their,
so they stay as they are.
A.
So you think rates should stay as they are, at 4%?
I think it makes sense to pause for a moment, or maybe have a quarter point rise in our terms.
Be it that, of course, if the Bank of England pauses, Vicky, what the markets don't like is uncertainty. I mean, some will be arguing now, because inflation has peaked, and you and I have talked about this before, actually, the fact that I think you predicted 3 months ago that inflation had peaked, and you've been right, because inflation has dropped in the meantime. So surely interest rates from a Bank of England perspective should be coming down now, shouldn't they?
The problem what we've got is not so much that 4% is particularly high, because in real terms, of course, it's negative. It is that the increase has been so fast, as you said at the beginning, and so substantial when you look at the percentage increase that's taken place, that has made surviving, if you like, anyone who's borrowed money or perhaps is intending to refinance their mortgage is going to find it inaffordable. And not just, of course, individuals, but also businesses, which have seen their costs go up very significantly. And we've seen that already in the number of insolvencies that are taking place.
So to recap, since the beginning of 2022, really, we've seen almost an interest rate increase from the Bank of England every month. The average mortgage payer now, although obviously some homeowners don't have a mortgage, let's be clear, those that do have a mortgage, a large percentage are on fixed rates, so they're not immediately affected by Bank of England variable rate fluctuations. But the average person with a variable rate mortgage is currently paying about 25% more for their mortgage than they were maybe 12 months ago. I guess to your point, the problem is, of course, that lack of certainty from a consumer perspective. And I've got to say, some would say, fueled by the media. I mean, I don't know if you would agree with that. Has the media got a part to play here in terms of the hyperbole around interest rate rises and uncertainty?
It's interesting you say that, because the surprising thing is that consumer confidence and business confidence had been improving a little bit recently, mainly because the government intervened, and of course what we now know is that the electricity price guarantee is going to carry on for another 3 months. Yes. Second, because people have seen pump prices come down. So petrol prices have been declining quite significantly. Oil prices right now are where they were.
Still not quite in line with wholesale energy prices.
It never does. It never does. But we're back to where we were a couple of years ago, before the invasion of Ukraine by Russia.
The truth is that consumers are not feeling too bad, mostly. Of course, there are some people suffering.
Some might take issue with that in the comment section in a second, I think.
Well, they might, but you can, just by observation and reading lots of different kind of figures from different industries, hospitality industry, travel industry, people are beginning to spend again, particularly spending on their holidays for this summer.
Isn't it remarkable that despite taxes going up, despite the fact that we've had energy costs at an all-time high, despite the rhetoric around the media saying we're going to hell in an economic handcart, which is pretty much what the message has been, do you think that's testimony to the British people and their resilience?
I think so, and I think it's pretty good news. But of course, just look at where they're spending. Yes, pubs and restaurants with a bit of luck, they'll carry on doing that. Retail sales have gone up again a little bit, but they go up and down, so we have to just watch that. But the problem is that despite all this, despite the fact that yes, they're going out and spending, and yes, when they travel, of course, it's an export. Sorry, it's an import in the sense that they spend it somewhere else mostly, even though obviously they use some facilities.
So they're growing somebody else's economy.
They're growing someone else's economy. We are getting some tourists as well, but
so your message is don't go on holiday.
No. Well, I mean, they're happier. Well-being matters a lot. Maybe they will be spending more generally. But what you're seeing, nevertheless, if you look at the economy and how it's going to be moving, we are not doing anything major about our businesses. So businesses are suffering still.
Especially
so
with
investment
the
is not
tax
really
increase from 19 to 25%. That doesn't help, does it?
No, it doesn't particularly. But what the government is saying is that we need this extra cash because we're going to be, they've already more or less hypothecated it.
Yeah. Roll forward 12 months. The people watching this that are thinking, okay, my mortgage is costing more. My energy costs, whether it's the fuel I put in my car, although Vicky's right, those costs have come down a little, but certainly the cost of heating my home, all of those costs have increased. Yes, it might start to get slightly better, but is there a crumb of comfort here, looking 12 months down the line for the average consumer, where actually we all think perhaps that they're going to be in a better position in 12 months' time than now?
Yeah. Well, the crumb of comfort is that prices will have stopped going up at the rate they have been going up, but they won't go down. We're not going to nobody's expecting deflation, so we will end up at a price level in relation to our incomes, which has changed for the worse. That's for sure.
Vicky, 12 months' time, thumbs up, thumbs down. Where do you think we're going to be? Room for optimism?
The expectation is that we might indeed, even if interest rates don't move, if they go up to 5%, or if they come down to 2.5%, whatever happens in those in the range, we're still going to have almost deflation, and certainly move to target by the end of this year, more or less. And then for 2024, unless something else happens, we will be below the target level that the Bank of England wants. So there is no reason, going back to your original question, on why we should be raising interest rates, because the path is going to be one to get us back to target, unless, of course, the war escalates and something terrible happens that nobody can.
Let's see if the MPC agree with you. Vicky, Martin, for now, thank you very much. So, with the cost of living still at the forefront of our minds, let's take a look at the Basket League this week, our analysis of the cost of essentials at each of the major supermarkets, so you know where to spend your money wisely. Each week we analyse the price of 12 staple products, and there's been some changes this week. Asda have seen the most change this week, with tomatoes and baked beans down, but beef mince and onions amongst those seeing increases. All this means that the most expensive this week is M&S, again at £22.75 for their basket. Next we have Asda on £22.90, and that's up nearly £1 on last week. What's happening there? Sainsbury's is bang on the middle this week on £20.27. That's a 40p weekly rise. Tesco just scraped second cheapest on £20.24, but goods have still gone up by 10p. We talk about inflation. And once again, the cheapest is still Aldi. Their prices stay locked at £17.96. Well done. And now to this week's audience questions. And the first one this week is from Dawn Shaw. She says, I have an instant access savings account. How much will the interest rate go up to, and will I get more on my savings? I have a bit of an issue with things like this because the numbers seem to rather indicate that even though the bank rate has increased by 4%, as we've said over the last 14 or 15 months, the average savings rate by financial institutions has only gone up by 1.5%. Now, I'm not suggesting you two are going to want to kind of protect the bankers here and say, well, they've got to make a margin somehow, haven't they? How else are they going to make billions and billions of pounds? But how on earth can it be justified that that margin hasn't risen in parity? And how can Dawn ensure that she gets more for her savings, given that interest rates are increasing, as we've said, and have done?
I think it's quite right that on average they haven't gone up, but there are some special accounts where one can get considerably better rates. So some at 4%, 5%, one can still get them, but of course you then put your money in possibly for a longish period of time, and there are also restrictions as to how much you can put in it. But if interest rates go up, and the Bank of England raises rates, then there will be some push, because in fact all the banks had to go and explain themselves in Parliament as to why.
Does that make a difference, Vicky?
Well, they all went back saying they're going to do something about it, but I think it's worth you sort of checking that and seeing whether it's
still down here with kind of estate agents and traffic wardens, aren't they, in that respect? Martin, are you now going to protect your old friends and your old banking world?
Used to be a banker for 15 years, but I wouldn't defend them at all on that. I think it's an absolute scandal that deposit rates don't go up at in parallel with lending rates and with official interest rates. And it's a pain in the neck to shop around to move your money. You don't know how safe each the competitor banks are going to be. So there's a lot of inertia. Banks know that. People generally leave their money where it is.
I think really the message is shop around, don't necessarily trust your bank in terms of them ensuring that they increase rates as they should as the Bank of England rate increases. Okay, so the second question is from Will Robinson. Why haven't wages gone up to keep up with all these increases? Martin, why haven't they gone up? Inflation, 9.7% today, I think it is.
Well, they haven't gone up because employers generally would argue that they couldn't possibly afford to put them up in line with inflation running at 10 and 11%. So they've been making wage offers sort of a lot of people still talking about 3 to 5%. So that's a real pay cut. The fact is employers can't afford it. And the other fact is that if everybody was having wage rises in line with inflation or even ahead of it, inflation would be accelerating.
Is there some magic wand that can be waved?
Yes, go and work in the right sector. So if you look at the financial sector, people are doing quite well there.
Well, the banks again.
Yeah, I'm afraid so.
Go out of nursing, go into banking.
Yeah,
oh dear.
Absolutely, professional services. So if anyone is thinking what to study and what to do, and what career to have, perhaps that's the one. But of course, right now we're in the middle of a bit of a shakeout in the banking sector as well. So perhaps this doesn't last for very long. But so far, this is where the increases have happened. And occasionally we get sharp increases in places like the hospitality sector, because we've lost lots and loads of workers who went back to Europe, post Brexit. So there's been a bit of that, and loads of people just haven't gone back to those sectors either post COVID.
But I think the real message here is, from a career advice perspective, just be a banker, because you'll get huge pay increases, you'll be able to spend customers' money irresponsibly and then just get bailed out. I mean, sounds
everybody
ideal.
hates you.
Sounds fantastic, doesn't it? Next question, the last question for this week is from Cecilia Tucker. She says, my mortgage is due for renewal. I have always had a fixed rate. I'm now wondering whether to opt for a 2-year fixed rate in the hope that interest rates do come back down. I normally opt for a 5-year fixed rate, and what should we do? What's the advice? 2-year, 5-year? Stay on a variable for a while if you think maybe that interest rates are going to start coming down to you.
You may want to go to a tracker mortgage for a while, and then
base rate tracker.
Yes,
yeah.
and then see what happens after, because I think yields are coming down, which means really the long-term interest rates are coming down. It's not so much to do with the central bank's rate, which is a short-term one. Yeah. It's got a lot to do with bond yields, which are at the longer end of the market. That's how mortgages are basically priced.
Martin, what would you do? What's your advice?
I would maybe go for a 2-year fix. I mean, I'm picturing a sort of return to a perfect world where interest rates actually are probably around 4% or thereabouts. Inflation is around 2%, so there's a real return on savers
Vicky's
money.
disagreeing.
No way you can
She's
have
disagreeing.
you can have
But
real interest rates being so high when inflation
but
is so
that's-
low. It would kill the economy.
That's but that's the normal world that you and I were brought up in for our first, in your case 40 years, in my case 60 as it were.
Very kind, isn't it? It's very
It's been
kind.
very kind. Can you do this
So
again together?
I don't imagine interest rates ever coming back down to 1% and below. That was a weird, freakish period as a result of the nearly destruction of the financial system in 2008. So I think that a normality of interest rates is 3, 4, 5%.
Or here's another bit of advice. If you're a banker, take our advice, you won't probably have to have a mortgage at all. So that is it for today. A big thank you both to Vicky and to Martin. Thank you very much for coming on. Hopefully you've enjoyed yourselves. You didn't tear lumps out of each other. You kind of agreed a little bit, I think. So
Very worrying.
Yeah, but look, and let's hope that your optimism is well founded. I know we don't have an awful lot of time and expectation from experts anymore, based on expert opinion over the last few years being completely wrong, really. But I think you guys might be the exception, actually. So, okay, so look, thank you again for watching. Hopefully this has got you interested in interest rates, and make sure to like, comment and subscribe, and we will be back again next week for more Money Talk. See you then.